and fennel sausage rolls. We've got 3 great panels over the next hour and a half before we all meet outside for drinks to end day 1. Now, do you want the good news or the bad news? The bad news is that Wise's Anthony Nant is not going to be presenting this afternoon. Do you want the good news? Dr. Lily Sussman, the Chief Strategy Officer from Wiser, is going to present instead. Go berserk! Come on! Woo! Yay! Because she is totally awesome. Unfortunately, Anthony was raided by ASIC a little earlier today, and they still have him tied up to a chair. No, that's not true. I just made that up. But Dr. Sussman previously worked at Social Ventures Australia, the not-for-profit. She's been in this space for a long time, having done some pretty epic things along the way, having studied at Harvard University, where she got a PhD in political science, having also taught at Harvard and Yale. My daughter might want to talk to you a little later on. She kind of has this whole Legally Blonde thing going on, so she's slightly obsessed with American universities. But Lily has a diverse international experience across public, social purpose and corporate sectors. She's worked with government, international development organisations and CBA, where she was the head of payments strategy through the mid-2010s. She was the project leader at Boston Consulting Group, as I mentioned, CSO at Social Ventures, now at Wiser. Of course, Wiser was recognised as one of the fastest growing tech companies in Australia by the Deloitte Technology Fast 50 Awards, coming in at 21, up 66 places to 12 in the 2021 AFR Fast 100 list. In 21, it was placed 8th in the Best Places to Work as a first-time entrant, and then number 2 this year, and took out overall the most outstanding practice for diversity and inclusion. So they know their onions. Please put your hands together and give a big clap to Dr. Lily Sussman. Thank you, Lily. Over to you.
Thanks for that intro. I was almost hoping they weren't going to change my name in the program and it'll be left as Anthony Nantes, because then I could make a funny joke about how many of you might be walking in and asking, could she be Anthony? Could she? I was like, I could. But a little bit less Australian, maybe a little bit less dry wit. I'd say equally sassy, and definitely equally passionate about what we're going to talk about today. So thanks for the intro. I am Lily. I'm the Chief Strategy Officer at Wiser, and I'm really, really happy to see all of you here because we're going to have a very fun chat together today. We're going to talk about impact. And I know you looked at the title of this talk and you said ESG, and you're like, oh yeah, ESG. Well, let's see if you still feel that way by the end of it. I'd love for this to be a bit conversational, so I'll talk, but please bring your questions. Let's have a robust discussion. So, before we get started, I'd like to acknowledge the traditional custodians of country throughout Australia. I know people are watching this broadcast from all over Australia, and I'd like to pay my respects to elders past, present, and emerging. And I'd like to take a pause to reiterate our continuing support for the Uluru Statement from the Heart and our continuing support for the voice of all Aboriginal and Torres Strait Islander communities. Great, so what are we talking about today? We're diving into ESG today. It's one of those topics that I'd say has gone from the fringes to the mainstream. The environmental, social, and governance standards of a company used to be something that we talked about kind of in the same breath as regulation or corporate social responsibility. But I would say nowadays it's actually much more mainstream, and really it's just core to what we do as businesses. It is now synonymous with and is in fact commercial strategy. Now, many of you in the room will be familiar with Larry Fink. Larry Fink is the CEO of BlackRock. And BlackRock, of course, is the world's largest asset manager. BlackRock manages 10 trillion USD of capital in the world. And Larry's been quite famous for going on the record and reiterating this in many places, saying that profits are in no way inconsistent with purpose. And in fact, profits and purpose are inextricably linked. Now, that's quite an interesting comment, because it's actually a 180 from what many of us were taught in business school, which is a Milton Friedman school of thought. Milton Friedman was a famous economist who said the job of any business is to focus first and foremost on profits. Milton Friedman's way of thinking was quite dominant in business for decades after shareholder capitalism was introduced in the 1950s. But things have been really changing under the radar, especially in recent years. Climate change, the Me Too movement, Black Lives Matter, the importance of social movements like the ones that are very relevant right now, especially in the UK around the trans community, the growing prevalence of trends around mental health and human well-being, seeing the human as an ecological and a social animal, all of these huge global social trends have created brand new conversations in all of our lives and in the context of shareholder capitalism and in our businesses. We are now all talking about the circular economy. We're talking about decoupling growth from consumption. We're thinking about conserving the world's resources and habitats and biodiversity. We're questioning what is human and other species well-being? Do we even understand it? Why are we having such a mental health crisis in the world? And conscious capitalism, the idea that business can and should be fundamentally doing good, is an idea that's spreading like wildfires on the rise. And capital, importantly, is following suit. Both investors and customers increasingly want to engage with and invest in and have a relationship with ethical brands, purpose-driven brands that are thinking deeply about human impact and not just profits. This has become table stakes for business. Now, ESG considerations, environmental, social, governance standards, impact, it was something reasonably marginal, I would argue. But there's all this increasing robust evidence now that makes it clearer and clearer that long-term total shareholder return, or TSR, is actually best served by focusing on impact. And the research shows that purpose-led companies deliver twice as much long-term TSR. And companies that take ESG seriously, not as something they have to think about in addition to core business, but as the core business itself, those companies are attracting more capital and they're delivering greater returns. Now that's a curious puzzle, because we used to think about ESG more as a, do no harm. It's more of like a negative freedom. It was, in some cases, a regulatory tick-the-box exercise, mainly to ensure we didn't pollute in a big way or support substandard labor practices like modern slavery or corruption. But now all of this is changing. It's not just a don't do X, which is sort of a negative freedom, but now it's a do X. And X is about doing good. And research is showing that positive impact delivers greater returns. And investors are taking notice. And investment into companies that score higher on ESG has exponentially grown over the past decade. It's actually expected that by 2025, there's going to be 50 trillion USD invested into ESG-specific assets. And you can see a clear trend of year-on-year growth in investing into companies that are more robust and clear on their ESG impact. Now, we are no strangers to this in this room, I know, because our sector, the financial sector, we're more attentive to ESG strategy than most other industries in the ASX 200. So we already are, and that's not a surprise because we're investors ourselves. We're close to these trends, and we see where capital's going. We're close to it. And yet, what does ESG really mean to you? Like, could each of us stand up and say, yeah, I know exactly what this means to me and what this means to my business and what my business is doing about it? How do you actually put a value on it? How do you think about ESG in the context of your business, and how do we measure it? Well, the thing is, if you ever investigated this topic, or if you've never investigated it, either way, either you're deep in it or you're not deep in it at all, you'll see that it's kind of a complex thing, measuring ESG. Firstly, there's not one universal framework, because there's a number of fairly popular ones, and different companies and different investors will use different things. So we've got things like the UN Sustainable Development Goals, the Sustainability Accounting Standards Board, and Morgan Stanley Capital International's ESG ratings, which is very often used by fund managers. These are just a couple of the popular ones. Today, I'm going to spend some time making the argument that we have been getting a lot better on understanding and measuring and thinking clearly about E and G, which is environmental impact and governance impact and quality, but we have not made very much progress on S, which is social impact. Money managers and investors have paid closer attention to E, measuring climate change and carbon impact, sustainability of resources, impact on habitat agriculture, G, corruption, executive pay, board issues, things that we see a lot in the headlines. They've paid a lot of attention and put a lot of money towards those, but they have not put as much money or as much attention to S. When companies have attracted ESG earmark capital, investors have predominantly focused on looking at E and G criteria. And that means a lot less money has actually flowed to S than E and G. And why is that? Well, first of all, it's just easier. It's easier to measure E, for example. Environmental crisis, we know, has become a pressing issue for our generation, and we are, rightly so, developing better and better ways of measuring carbon footprint and emissions, looking at Scope 1, Scope 2, and 3 emissions, and ways of measuring that investigate the entire value chain of a company. Weiser was an early leader in FinTech in becoming a climate-positive organization, and we've been working hard to try to really robustly measure not just our direct activities from our offices and operations, but also of our suppliers, and plus everything like corporate travel, as well as what our employees do while they work from home. And we've offset our emissions with pretty high-quality projects aligned with the aims of the Paris Agreement. We've been working on deeper changes within the Weiser community ourselves, because the change needs to happen in us, right? And so we've been working on ourselves through green initiatives among our people, like clothing swaps, worm farms, eat one more vegetarian meal a week, ride your bike to work. You know, loads of small ideas, but just to raise awareness and to get people thinking about it. Not in a pushy way, because behavior change is not overnight, but in a way that we're trying to really grapple with it. And that's been easier, because it's well understood, this E thing. It's a lot easier than when we've tried to put our minds to the S. Michael Trail, who leads the Australian government's Impact Investing Task Force, has pointed out that in the world of impact investing, a lot of good has been done, but the social element of ESG really has been missing in action. And what in the world is S anyways? You know, traditionally, we've focused on thinking about S as kind of a minimum set of standards around human labor practices, modern slavery and global supply chains, basic employee protections. But what about true social impact? What about the positive impact on human and societal well-being? There's an increasing trend everywhere around the world in the rise of purpose-led companies. I know there are a lot here among the fintech community here in Australia. And there's an increase in number of B Corps and businesses that believe themselves to be ethical and forces for good. And if you're a business that's a force for good, you typically have a positive human purpose you want to achieve. Some kind of positive impact on your customers, some kind of positive impact on society that you're looking to unlock, that you're trying to build in the world. But how do you know? How do you know if you're a force for good? How do you conceive of and actually measure that positive impact? Like, how do you define S for your organization? Now let's look at the example of Morgan Stanley Capital International's ESG measurement framework, which is used by many institutional investors worldwide. It's a pretty robust measurement index. It rates companies from CCC to AAA with individual measures and scores for each of E, S, and G. The framework has a number of different ways that it uses to measure S, looking at human capital, labor standards, product liability, stakeholder opposition, and social opportunities. And this is all great, but a lot of it still has a strong vibe of do no harm, rather than the positive mandate of do positive good. And so today, I'm proposing that we here have an opportunity ahead of all of us. We have an opportunity to take that S that's missing in ESG and create something meaningful. We have an opportunity to better define and measure true social impact, which is impact on human well-being. An impact, positive impact on human well-being, it's something that's actually pivotal to the financial services sector. You know, we're an increasingly ESG conscious sector, but we've historically tended to think about social impact as increasing access to financial services and capital, and increasing velocity and efficiency and liquidity of the financial system itself. The next frontier for our industry, for us, especially those of us who understand that purpose drives profits and are passionate about building the next generation of inspirational, successful, purpose-led businesses, the next frontier for us is moving beyond increasing access and inclusion to increasing impact. And I've just heard a talk in the last panel from Justin at Flux talking about the mission of Flux being to build the most financially well, responsible, empowered younger generation in Australian history, right? That's one way of thinking about impact, but how would we measure that? It's a great place to start. I think we have an opportunity to actually define the S in ESG as social human well-being and focus more intently and more deeply on this idea of what is well-being, what is financial wellness, what is financial health. We've all been warned with examples we've seen splashed all over global news. You all probably know the story of the young 20-year-old college student from Nebraska who was trading on Robinhood, the fintech in US, a consumer trading platform. It reached incredible scale very quickly, offering free trades. But it was dragged through the mud when a 20-year-old committed suicide because he was trading on the platform and he thought he had suffered a really big loss and he didn't really understand it. And he hadn't actually suffered as big a loss, but he didn't realize that, and he thought he would be getting his family into trouble, and he took his own life. Now, that's just one example, and the Royal Commission has happened here. We all know about that, right? But putting the focus squarely on positive impact and human impact, and thinking much more sharply and deeply about the S in ESG, that is the invitation and the next frontier for our industry and for all of us here in this room. Because financial services is actually at the very bottom layer of Maslow's hierarchy of human needs, we are constantly, with our businesses, touching on the security layer for our customers, as well as, for many people, the flourishing layers of the hierarchy of needs. And so we should be paying attention to the S. We should be paying attention to human well-being and measuring and defining that better. Those of you who know us, you know that Wiser is a purpose-led company, and our purpose is financial wellness. And that means that we have the challenge of defining what that means. We literally have to exist for the S in ESG if we're a purpose-led company. So what is that? You know, it's not an easy thing. We have a financial wellness platform and unique credit products where we want to help people access credit if it's responsible and the right thing to do for them, but we also want them to be able to pay it back as quickly as possible, and we want to meet their financial and emotional needs along the way. So yes, we are a lender, but though we are a lender, our biggest loan category historically was debt consolidation to help people replace high interest rate debt with lower interest rate debt, with an end date, with a clear plan and path, and with as low interest rates as possible. And we encourage our customers to pay off their loans faster, and we've built proprietary tools and features that help them to do just that. Our data actually shows that 43, almost 50% of our customers pay early. They make early prepayments, and they're measurably paying off their debts faster. And we work really hard to really try to make sure, we were just talking about in the last panel about responsible lending, to try to make sure that we do the hard work and ensure we don't lend to people who can't afford it, and we don't want to put anybody in financial stress. And we are trying to help even the playing field between lenders and borrowers by educating borrowers on how lending works and understanding where they are and what they need to do to improve, and how to improve their financial habits, how to improve their financial emotions, their financial well-being. And fundamentally, it's really about trying to recognize that everyone is deeply human, and therefore everyone's well-being is our business. And putting human well-being at the center of how you manage a business, you've got to recognize that well-being is this complex, holistic thing. You have to be authentic to have well-being. You have to have open emotional space in order for someone to feel like they can be themselves, for people to have their needs heard and met. And that means that it starts from the culture within Wiser and how we engineer our processes and the way we communicate with customers. And the way we treat our staff, that has to be the same way we treat our customers, because we're just all human if you put the human and the human well-being at the center of what you do. We've consistently won awards for being one of the best places to work in Australia because of this, and I'm very personally proud of Wiser this year being the national winner of AFR's Best Places to Work in Diversity and Inclusion in particular. And we try to bring that focus on everyone's deeper humanity and who they are underneath all the masking, and the holistic well-being to customer interactions, and as well as how we connect with each other and with employees at everything, whether it's town halls or just at the water cooler or over Zoom. But we are far from perfect. We need to get better. We want to get better, especially at measuring and delivering on our core purpose, which is the S that's missing in ESG. We're a climate positive organization. We're actively engaging with our workforce to talk about the environment in an open, non-judgmental way that still helps us to get more educated, allows those of us who are passionate about it to share their passion with the rest of us. And we've been working on our governance and recently added more female representation. So now we've got 40% female board composition. But most of all, we have been working, and we need to put a lot more work into the S, because we really want to get better and better at measuring the social human impact that we're having, that our purpose-led model is having on our customers as well as employees. So last year we eliminated our gender pay gap, and we've been working hard on diversity inclusion, and particularly in building EQ and paying attention to this notion of holistic well-being. And we know that customers who engage with our financial wellness-focused tools, they don't just come and get a loan with us. They come to us, they want to improve their lives. They want to feel less stressed out. They have life goals they want to achieve. And what we can do is help them with that in one way or the other, whether it's giving them credit if it's the right thing for them or not, or helping them pay off their loans faster, improving their credit worthiness, learning what they need to know, being talked to like a human. But we want so much more. Our challenge, and I think all of our challenges, is to redefine what deeper financial wellness really is. What does our sector really exist to do? We need to set and continue to set a high bar for defining this, measuring, and holding ourselves to account to achieve it. We need to be very clear. What does S mean? How are you going to measure it? How are you going to prove it? And so there's a lot more work to be done in the coming year and years. Wiser's been winning a lot of awards alongside many of you here today. But it's not time to rest on our laurels. Our sector is challenged right now. Tech stocks have dived, there's been dramatic rises in the cost of capital and the cost of living, a host of difficult challenges from uncertain macroeconomic conditions. In a bear market, and when things are uncertain, it is that much more important to recommit to what you stand for, and recommit to making a positive human impact, putting that front and center of what problem your business exists to solve. So today, I want to raise a call to action here at Intersekt. We've seen that while ESG has become more valuable and attracted a lot more institutional investor capital from around the world, we've gotten more and more robust at measuring and delivering on E and G, we haven't really thought enough about S. It hasn't attracted as much capital. It's not as well defined. There's so much room for innovation. That's what that means. Innovation that's going to attract capital and that's going to make a difference in the world. So we can sit around and we can wait for regulators to tell us what the S in ESG is, which they will. I'm sure of it. They have in the US and UK and Europe, and Aussie regulators are catching up. But we don't have to do that. We should be setting the bar ourselves. We should be leading. We should be the visionaries that redefine what financial services can be creating in the world. And beyond provision of financial rails and enabling liquidity and access to capital, which we've done, what if we focused more on the S and we focused more on deep human and societal well-being? What does that look like? What new business models and creative new ideas would we come up with if we set that as a central challenge for ourselves? I know that Wiser has a ton of room for innovation and for pushing the envelope further. And I know that so many of you in this room are inspirational leaders and you want to make a positive difference. Everyone wants to make a positive difference with our time, with our energy, the time that we spend at work. So let us do that together. Let us take the missing S and let's make it incredible. Let's make it deeper. Let's make it robust. Let's attract the growing capital that's available to us. Let's make big things happen by redefining that. And let's make the world a better place, putting ESG and especially S at the center of what we're thinking about and what we're solving for with innovation. My hope is that I'm going to see more of you next year standing up here and sharing back your stories of how you've pivoted your business or better defined it and created new ESG impact and how you're measuring it and how you're thinking about it and you're leading the path forward and paving the way for the future generation of innovators. Thank you for listening. Thank you for bearing with me and the fact that I am not Anthony. He would have loved to be here today, but he had a family emergency. But thanks so much for showing up, and I'm going to take questions.
Ladies and gentlemen, please thank Dr. Lily Sussman. Lily, I'm going to kick off with one. I've been around the Oval a few times, and 20 plus years ago we used to talk about triple bottom line, trying to do the right thing. Business kind of fell by the wayside. ESG feels a little bit like that. But my question is a generational one, because I've found this fascinating. As I talk to founders in the fintech and many other startup spaces, that sense of purpose, that social aspect, having a social license around what you do and operating in your community and with your business, is this really strong ethic in the new next generations that are coming. And to me, that means that if you don't get that as a business, they're going to cut you from their list. Do you have that sense as you look around and let's say the millennials and underneath are the people who are making these decisions about how they spend their money, who they spend it with, by the social license that a company has?
Yeah, I hope I made the point first and foremost that even if you're a bottom line kind of person, the evidence is very clear that purpose is going to better drive your bottom line. That's just what the evidence says. And that makes a lot of sense because you've created a win-win business model and you're very, very close to what your customers want. But the point you're making is that customers want really great businesses that help them with their human well-being. Of course they do. So, it's not just a millennial thing, it's a human thing, right? Like maybe we're willing to put up with a business that we're very unclear about if they're doing good or not, if they're really helping me or not. But, that's only if you're not putting it side by side with a business that's so obviously helping to improve human beings. Once those are side by side, that competition comes in, you know who's going to win. So I think it's both. I don't think there is a trade-off anymore. There's no trade-off. There is a clear path forward, but we've got to just go there. right? We've got to say, okay, what's my business for? I'm going to define the S.
Anyone here questions? Anyone want to define the S? Daniel.
Hi, Lily. I run a B2B business, and I'm really curious as to your thoughts on how you do the S in that context where you're not touching the consumer directly.
You know, B2B is like B2B to C in a way, right? Because at the end of the day, all business exists to serve humans. That's what it exists for at the end of the day. Somebody down the supply chain, somewhere in the value chain, is buying it. So, I mean, how do you even have a conversation about social impact? What are you talking about when we're talking about human well-being? Right? It sounds like very fluffy, just like the environment used to be very fluffy. Like, what is it? Until we got more robust about it and really said, look, let's define it this way, let's think about it this way, we're going to segment it this way. Same thing with S, and that's through conversation. You know, as a B2B business, you have so much opportunity to shape the conversation with whoever is buying your product, right? And ultimately, they're only going to buy your product if it's helping them with their product and their customers. So there's 100% a connection. You know, I think we're all capable of going out there and thinking, what S do I stand for? What do I want to see? What would S mean for me? How am I going to talk about my business like it's an ESG business, and I'm going to exist to serve one of these impacts? I don't know if that answered your question.
Any more? Lily, I think they've got it sorted.
Okay.
Ladies and gentlemen,
Okay.
please put your hands together and thank Dr. Lily Sussman. And all the best to
Thanks,
Anthony.
guys.
Hope the whatever's happening in the family is all good and sorts itself quickly. Give him our love. All right, please come in and settle down. Great to have you in here for our next session. And I just thought that was fantastic. Plenty to think about. And I do think about it all the time because when I talk to founders about their purpose, the passion that runs through it, I think, is such an inspiring part of a new generation of businesses that are emerging. Because some of the older ones I grew up with didn't quite get that, and it's really interesting to see who's being left behind and who is making a lot of ground and a lot of money along the way too, which is, of course, the other important part about it. Well, we're going to strike that balance now between identity fraud fighting and seamless customer experience, from ESG to KYC. And for our panel now, we have James Civic from Ekata, we have Matt Bourne from MasterCard, Michelle Henderson from Immersive. Michelle, I'm going to have to work on that because the spelling and the lack of vowels, I think it's almost like a New Zealand thing. And of course, our moderator is Ashmita Das from Probe Group. Ladies and gentlemen, please put your hands together and welcome our fabulous panel to the stage. Come on up, guys, for identity fraud fighting and seamless CX.
Good evening, everyone. Welcome to today's panel, and thank you for the introduction. But just to give you a quick introduction, a little more in detail, I'm Ashmita Das, one of the lead business consultants with Probe Group. Today we have in the panel James Civic, who is the Director of Business Development at Ekata, which is a MasterCard company, and he comes with 10 years of experience in e-com, fintech, and payment space. We have Matt Bourne, who is the VP Digital Identity at MasterCard, and he leads the product development and enablement of the identity services in the Australasian market. And lastly, we have Michelle Henderson joining us all the way from New Zealand. She's the head of brand at Immersive, a pioneer in Web 2 and 3 payment platform protocol. So welcome, panelists. And the topic for today is striking the balance between identify fraud fighting and seamless customer experience. So to start that, we all have witnessed how the consumer behavior has changed over the past decade or so, thanks to all the social media and some of the tech pioneers like Uber, Netflix, to name a few. We have been spoiled with their seamless customer experience, and if not equal customer experience, but the requirement, the kind of customer experience that we expect from any online platform, that has kind of raised a bar. And that is where companies are working more and more every day to improve their customer experience, but also understanding the fact that with the increase in the digital data, there has been an increase in data phishing, data frauds, and which has led to a lot of scams and frauds. And that is where the companies are now tasked with not only taking care of the customer experience, but also finding ways to safeguard their data and also prevent fraud. And with that thought in mind, let's hear what our panelists have to say on the first piece of the puzzle, which is on the consumer behavior, how it's been evolving every day, and what is going to emerge out of the Web3 and how the companies are kind of working towards it. So James, if you would like to start.
Sure, can do. So I suppose the main thing for me is big convenience. Users expect more and more convenience. People in the industry will talk about frictionless, but the reality is, yes, people expect it to be very, very quick moving, but they expect it to be at their convenience. If something exposes their security or exposes their identity, if we're talking about identity perspective, that is very, very inconvenient to them. No one wants to go through a data hack or lose their identity or anything like that. So convenience is really the key perspective here. As well as that, I suppose everyone wants a personalized experience, which is always a little bit interesting because people want to talk about privacy, and they are very much more aware of privacy at the moment, so they want to ensure that they have that personalized experience, a dynamic experience that is centered on them, because it's the convenient perspective. And that's not a trend that's going to go away in the next whatever. I'd be very, very surprised if anyone says, yeah, I want to be blocked at every single transaction I ever make or every single digital interaction I ever make. So that one mainly.
Yeah, thanks, James. Look, I totally agree. I think every consumer is looking for a frictionless experience. We all want to deliver that. We all want to make things fast and easy and convenient. And I think, though, that often when we're building a product or a business or a fintech, sometimes that's often when we think about what is consumers' expectation. That's kind of where our thinking stops. I love that talk before about ESG. You know, how can we think about that as part of our proposition? But I also think about trust as well. And it's not just about product trust. You know, does my product add value for money? Does it do what it says it does? Can I show to a customer that I've got good reviews and testimonials? But I think a lot of it is about demonstrating to consumers that they can trust us with their privacy. They can trust us with their data. And if we're a fintech business, well, we better be showing that we're trustworthy if we're dealing with people's personal information, if we're dealing with their financial information. And so I think there's lots of awesome, I can see with a lot of fintechs, they've got this great narrative on privacy and trust, but there's plenty of others that, you know, they kind of just talk about security, they slap the badge on the side, they say, you know, we use bank-grade encryption and our privacy notice is kind of hidden out the back, and we don't really promote, you know, the quality of how we think about your privacy and data enough. So I think the best businesses in the future are the ones that talk about that well. And I think organisations like Apple are clearly very good at that. You know, whether you think they do it for a business imperative, clearly they love talking about privacy and data. How were their products, whether it's not tracking you as you use the maps, whether it's not tracking what you watch on TV if you use Apple TV. You know, clearly those products, part of their narrative, their product speak, their marketing, is about how they can be trusted. So they talk about it, you know, they show it, and they really mean it. And I think the better organisations will be good at talking about how they not just do the right thing, but be very good at talking about how they do that well.
Coming from the community management side of working at Immersive, a lot of my role is Web3 and Metaverse. So I really wanted to focus mostly on the personas of who the Web3 users are. So 74% of all of these users are male. 50% of those people are below the ages of 35. And most of these people are involved in either gaming, GameFi, decentralized finance, or holders of crypto. So the main thing for the Web3 users is privacy, mostly. So if you look on LinkedIn, you'll see a photo of someone in a suit or a headshot, whereas the Web3 users mostly are representing themselves as avatars or NFT pictures or cartoon versions of themselves, because self-sovereignty and identity is really important for them to protect. And I think that's one of the main key stages of making sure that people aren't getting scammed, because all their information isn't out in the open. They can control what you see. So whether that be digital assets, information, anything that's private, you can kind of decide how you represent yourself. So a degen, which we call in Web3, degenerates, it's like the new age kind of users, they won't be using their government name. Like, I'm Michelle Henderson in real life, but the way that we represent ourselves online in the future will be a little bit less, my username is Miss Bear NFT. It's not Michelle Henderson. So I think it kind of goes all the way back to that. If you're pro-privacy from the very beginning, it's going to be easier to protect yourself from scams and frauds to begin with.
Thank you. And Michelle, if you would like to just, for the audience, give some bit of detail, what is the difference between Web 2 and Web 3?
Yeah, sure. Yeah. So the difference between Web 2 and Web 3 is it kind of comes all the way back down to the tools and the new age technology that we're using at the moment. So an example would be Web 3 crypto wallets, such as MetaMask. I'll use that as an example. So a lot of this kind of goes down to DIDs, so decentralized identifiers. So instead of, say, going onto the internet and logging in with your email address and a password, if you're anything like me, you probably forget all your passwords too. I think the global average is 100 usernames out there for each internet page. So these days you're going to be logging in with one authentication code with your Web3 crypto wallet, and that will be able to be seamless with every website that you use. So it's just one login, and I think it just keeps it a little bit more private when it comes to what you're sharing. So yeah, you control your own data sharing, basically.
Excellent, thank you. Pretty thought-provoking Web3 is, and pretty exciting as well. So now talking about the second piece of the puzzle, which is fraud detection, and what are some of the trends that we have been seeing in terms of what's happening, what kind of frauds are happening, and how the fintech, especially in the fintech world, how the companies are basically preparing themselves for prevention as well as to tackle them if that happens.
Take this one?
Yeah.
Look, I think fraud, as always, is evolving. And, I think we're seeing that bad actors are continually finding ways to attack businesses, whether it's money laundering risks or fraud itself. Interestingly, in the past couple of years, we're also seeing some of that, the threats migrate, unfortunately, to consumers as well. So, as businesses continue to invest in fraud detection and decent capability, and more of that gets out there, unfortunately, it's exposing some individuals as well. We're seeing scams now probably underreported at $2 billion of loss for consumers. The latest stats were affecting about 4% of the population have fallen victim to a scam. And so there's no victimless crime, but whether it's business or individuals, it's everything is, of course, on the rise. And I think Michelle talked about how do we protect against identity theft? We're just seeing this proliferation of data. Data can be good, can be used for good purpose and used for evil. And so I think when we start to think about privacy, protection, we want to make sure that it's harnessed for good and kept in the right hands. I think the bad news for fintechs is that, as we'd say in elections, there's no such thing as a small target. I think when it comes to fraud, if anything, the bad actors are targeting organisations who, in a way, are emerging with their best practice for, their financial crime or their credit assessment capabilities. And so, we had a customer not that long ago, who they launched on a Monday morning, opened up the website, and by Monday afternoon they're already receiving spurious and suspicious credit applications, and it really surprised them, right? So I think, again, no such thing as a small target, but the good news is that, and it's something we've worked at MasterCard to really kind of make all fraud detection capabilities more accessible. It's not just the realm or the remit of the big end of town. I think we see this with what we try and distribute to all of our partners and customers. We see this with innovation in the fintech community around whether it's orchestration or outsourcing of AML. Organisations like First AML or Lab Group are really contributing to that, to that confidence and trust, and to the smaller players in town providing that set of capabilities they need. But it's both technology and human talent that is what's required. But no easy answers. But I'm optimistic about the future when we think about whether it's Web3 and capabilities to help better protect users, or it's more in the now around the progress of digital identity. I'm confident about the future.
Thank you, Matt. And just to add to that, I had another question, which was more regarding, so MasterCard, all of us in some shape or form, we have used MasterCard. And what I've seen is when you're using a card, and especially if there has been a fraudulent transaction that has happened and that exceeds a certain amount of dollar value, the cards, they generally get automatically cancelled or disabled. But more from a banking standpoint or more from an insurance standpoint, I've also seen that when you're kind of logging in or signing up on a site, on a bank, creating your own account, sometimes it can be really annoying when you have too many times when you have to fill in the one-time password or re-authentication. So how do you kind of try to balance that? How much authentication is right versus the customer experience to prevent any frauds? Yeah.
I can't say from all the bank perspective, because the reality is every single institution will have their own flowcharts. They'll have their own user interactions they want to go through. The reality is that, exactly as you say, too much authentication, too many OTPs, anything like that is an annoyance. What Matt says, you want a trusted environment. What Michelle says, once you get into Metaverse Web3, you're using those tools, you should be never really exposed to it. There's a range of different ways you want to go through, and as I kind of said earlier, users want that convenience. They want to be treated as an individual on every single time, and they want it to be convenient to them. So it shouldn't always fall to what should the consumer do. It's what should also organizations do to take it upon themselves to protect those end users. That makes them a trusted entity that you will interact with if you're the consumer. So whether you're doing certain things like running collaborations with other people in your network to try and necessarily stop the fraudsters, but understanding the probability of whether someone is likely to be who they are. So then if someone has had their identity stolen or credit card stolen or something like that, what are the ways that you can detect through other interactions? It can be the way that their identity is behaving online. It can be the way that they are interacting with a device, a session ID, doing device fingerprinting, anything like that. So there's a few different ways that you can kind of do it, but it's ultimately up to every single one of the institutions to want to implement that change. And that, especially for some of the more traditional institutions, that's quite large. Matt said, we heard it so many times globally. Someone launched a new product. As soon as there's a change, fraudsters know about this before anyone else does. I don't know how they do it, but they are well ahead of it. So if someone's launching a new product on a Monday, the fraudsters somehow know about it and are able to take the system offline sometimes by that afternoon because they hit it so rapidly.
Just to add to that, Ash, though, you just talked about MasterCards at the start, and when I was talking before about trust, a lot of that is, who do I go to when something goes wrong? And we can't sort of play around with this, too much, right? We're looking after people's financial, not just their information, their personal information, and their money. And so I guess one of the things we're proud of in the card space is that people have a place to go when something goes wrong. It's why they have confidence and trust when they use a card. And I think when we think about, what is the recourse when someone loses their personal information? What is the recourse when someone bank transfers money to the wrong person in a scam? What is the recourse when I lose my crypto key and I've lost my wallet? Those are times when consumers first, they don't think about it until something goes wrong. And so we have to, whenever we want to digitise something and make things faster and easier and more convenient, we really got to think about those controls and think about how are we going to provide that confidence and trust, and how are we going to look after people when things go wrong.
Excellent. Thank you. And about the next thing that I wanted to quickly touch upon was, so we are looking at how the companies, and from what I understood from the conversation, was some of the businesses which have stayed, which are like a few decades old, they already have certain technologies behind running it, and they believe more in a, not in a prevention, but more of a fixing after the fraud occurs. They are going that path. So do you think that with the emergence of fintech and the new companies coming up, and with the new technologies which are coming up, it will be more proactive in nature, that we are safeguarding the data and avoiding or preventing the fraud before it even happens?
So I think I said before, we're just in this world of data. So if we think about what are the failings of KYC, today it is that we ask users to share a lot of information. It's not just about social networks, but when I open a bank account, it's not just my name, address, date of birth. I have to collect a lot of data like a driver's license, a passport, a Medicare card, a birth certificate. And often, we see that people ask for all of those just in case. Hopefully we get a match at a credit bureau with a government authority, and sometimes we don't even need that information. And the problem is that it's still a probabilistic approach. The user's not in control of that information. In fact, my 9-year-old son can take my wallet and probably open a bank account in 99% of the time with that information. He can sit at the keyboard and be me. So we have this fundamental problem that people aren't in control of their information. And they're sharing a lot. So a lot of data is getting out there. It gets hacked and breached. Even if you trust that organisation, it gets in the hands of bad actors, and the data can be replayed by someone else, and it's a vicious cycle like that. So we have to kind of flip that paradigm, I think. I don't know if it's a perfect analogy, but it might be helpful in this room. Like with open banking, we have this concept of a data holder and a data recipient. We have a concept of authentication with the place that it came from. And we have a very sort of defined workflow about how it should get to the place it needs to go. And more importantly, I can leverage trust that I have with somewhere else and bring that to the place that I'm going. So again, with identity today, I'm starting from scratch. When I go from bank A to bank B to the next telco, I have to pull out my documents and start from scratch. So it's inconvenient, it's data poor, it's privacy poor, and the fraud is still there. So I think if we think about digital ID in a sense where consumers can have a place of trust, it might be the federal government. Maybe we like our MyGov ID, maybe we like our Australia Post ID, maybe it's my bank ID, maybe it's a telco ID. All of these places, it turns out about half the population already have a reusable digital identity. We just need to unlock the ecosystem, build that interoperability, and build that acceptance. And if we get that right, we're sharing a lot less data, it's under our control, and we can fix some of these fraud outcomes for both our businesses and for consumers.
Excellent. Thank you so much. Any other points that you would like to add, Michelle or James?
Yeah, sure. So at Immersive, we are basically building the world's first decentralized credit card for the metaverse, so physical and virtual. So as you were mentioning, with Web3, you are your own gatekeeper of information, data, and assets from the very get-go. So all of this is done through private keys that you sign every transaction that happens. So as you mentioned, if you lose your physical card in today's world, it's got all the data on the front, it's got the numbers, someone can just easily go and drain your account and then you'll have to fix it later. Whereas you are signing for every transaction, whether that be in person, once we have our physical card built, as well as online as well. So if our website gets compromised, the transactions will automatically stop. So when it comes to fraud, because you are the owner of all your details, none of that can be compromised, and then there'll be no back and forths, saving time.
Yeah, I think it's probably a bit of both. You talk about traditional FIs, and the reality is that they've been around for decades and they still can't get it right. So you need to look forward at ways you can do things like this. Matt mentions that with federal government, you've got some kind of data sharing that's in the middle. The reality is that you look to the latest generation, they don't have that same level of trust in government that older generations do. So when you're looking at Web3, people have their own identity. They trust themselves to look after their identity more so than, especially government. You've seen it with New Service New South Wales had their driving license breach earlier this year. So 70,000 driving licenses, people had their details hacked. But that's not through the fault of the user itself. Now, it's difficult because phishing attacks happen. I received a text this morning saying my Netflix subscription be cancelled. Please click on this link. Unfortunately, I didn't click on it, so it's all okay. But that does happen. People make mistakes. So the reality is that new solutions need to be looked at, not just trying to reinforce those old solutions, which can happen. And yes, if you're looking at biometrics, that's very, very a good way of doing it. It's very, very locked down, but every single time you want to do like a minor transaction, do you want to go through that biometric? Not necessarily. Sometimes when you go onto these new technologies, people have that trust in your environment, and they have the trust in themselves. So really these traditional FIs and traditional companies in general do need to be looking to the future to try and embed that into their tech stacks, really.
Excellent, thank you so much. And just in interest of time, I would like to ask the audience if you have any questions for our panelists. Any questions? The fight or the balance between fraud identification and customer experience?
I think so. I think people are coming in.
Thank you.
I think we have one question. Right at the back.
Thank you. It's Raymond here, and I'm building a travel-ready app, and ID management is really, really key. We've heard about pros and cons and different models and whatnot. Could you share any best practices with us in terms of how to manage this?
For helping consumers manage an identity? Is that what you mean?
Identity management in general, in terms of, what I'm observing right now is there's so many handover points, so many points of repetition in terms of data and all that you've covered. Someone sitting here trying to set something up that's very much CX-led. What's the best practice? I know that line's not necessarily a hard line, but there's certainly, I guess we've got the best brains sitting on that podium there, just looking to get the benefit of that.
Yeah, I think probably touches on all the points that all of us have made during the discussion. I think you've got to make that initial experience amazing, right? You're in a competitive marketplace. You've got to spend all that money finding a customer, getting them to your website or to the App Store, and then you want to make it easy for them to sign up. So the minimum amount you need to trust them is what you want to collect up front. And as you begin to interact with them, begin to engage, you can maybe collect more. You can do that either kind of passively, about how they use their device, how they interact with their device. And there's lots of ways, both passively and interactively, you can continuously authenticate, who they are, and is that same person who signed up the one that's using your app. I think that's the way to treat it, is that, building an engine that, not over-engineered, but is simply saying that for the amount of trust that we need, we can continuously understand who they are. And if they do something high risk, if they're redeeming travel points or making a payment, and if it looks a bit suspicious, well, you've got ways to step that up. And it might be biometrics on the device, like the new FIDO capabilities. You might use something more sophisticated. But to me, it's about, as always, getting that experience right for the risk appetite that you have with that customer.
I'd also say on that, you can build at levels of incremental checks, or to go with what Matt says. So especially as you build platforms out, can you allow people on with a minimum amount of checking? So that can be ease of use. You look at apps that allow, they just need an email address or a phone number to sign up for. As you then start to unlock more and more interactions or services that you require, do you have to go through some kind of another level of step up? So that type of step up authentication. The reality is that you need to make dynamic flows for everyone to go through. So based on certain risk scoring, what your appetite is, what the product can be, and if you're redeeming loyalty or whatever, to put people through these different dynamic flows, which then satisfy both yourself, but them as well. And then if that allows them into your ecosystem and you allow them free reign, how do you then passively authenticate them? Are they going through an actual key every single time? Are you able to monitor things such as a behavioral biometric? It can even be, you see, I come from more of an e-commerce space occasionally, and people spend thousands of dollars every single year on UX in terms of where is the checkout cart placed, or how many clicks do you have to go through to actually get that experience done. So letting people onto there and understand that experience is quite key, and something that people are always trying to improve on.
Do we have any other questions?
I'm going to ask a quick one, Ashmita. Guys, I come from an era where we used to write a check and you'd wait at least 3 days for it to be cleared. Are we going too fast? We're now in an era where it's pay to, where we can do instant payments left, right and centre. And I was thinking about the other week, the story of a certain cryptocurrency exchange which accidentally sent someone with a fat finger trade $10.5 million when it was supposed to be about 100. Took them an audit and several months before they discovered it, and they're having some trouble getting it back now. Is there a way that we can kind of slow things down and maintain that customer experience and authenticity at the same time, so that those human mistakes that we all do make along the way can also be moderated as well?
I think the short answer is there are trade-offs with everything, and we love instant payment. We love fast transfer of money. And the problem with money is it moves very fast once it's out of our hands. And that was the same as cash as it is with things like real-time payments. I do think there are ways to improve. Part of it is about education. Part of it is, how do we protect the most vulnerable members of our community from scams? In a sense, education is sort of, it's avoiding the issue to some extent. And I think we need to be more thoughtful about technology and have we got the balance right? And are we doing the right thing by people? Have we got the right experience in place? Is this good enough for my family? Can my mum understand this? Is it good enough for her? So I do think there's a lot more to think about there with respect to the movement of money and have we got the protections in place. Like I said before, I think in cards, people understand and appreciate some of the recourse, and I think there's lessons to learn when we think about other ways that money can move.
Excellent. Any other questions? Last questions? All right. Thank you, panelists. Thank you for your time today. And thank you, audience, for attending the session. And thank you, FinTech Australia, for organizing this.
Thank you, Ashmita. Thank you all.
Thank you.
I think our audience is now here to see money move quickly into their account from venture capitalists, which is going to be our next panel. I have to say, the other question I wanted to ask Michelle from Immersive is, given her experience with the All Blacks, is what do you reckon, the Wallabies, any hope for us this year? Always, see, I love that New Zealand optimism. Well, gang, come on in, settle down, familiarise yourself with these faces, because no doubt you'll be asking them for money over drinks in about half an hour. We are going to talk VC trends and opportunities. and with an extraordinary cast of venture capitalists in terms of Ron Spector, who is the founder, of course, of 1835 or 1835i Ventures, Toby Norton-Smith from the CBA's X15 Ventures, Amanda Angelini from NAB Ventures, James Cameron from Airtree, and our fantastic moderator is Anthony Boogert from King & Wood Mallisons. Over to you guys, bring it home, finish our first day of Intersekt. Thank you.
Thank you very much. So I'm very conscious that this is the last session before drinks, so we are going to make sure we don't go over time. And so we'll get straight into it. We'll start off with just some intros. So Ron, do you just want to tell us a little bit about 1835i?
Yeah, good afternoon, everybody. Hopefully you're having a good first day. 1835i is the venture capital and innovation partner to ANZ Bank. So we spun out about a year ago. Used to be called ANZI. We are now 1835i, which was actually a combination of the year the bank was founded, got its royal charter in England, and the I to carry on the investing and innovation theme of what we've been doing for 5 years.
Hi there, everybody. Amanda Angelini, NAB Ventures. So NAB Ventures is the CVC arm for National Australia Bank. We've been around since about 2016, obviously investing in companies from sort of seed through to later stages, primarily a strategic investor, and looking to partner with most of the companies that we invest in.
I'm James Cameron. Thank you. I'm a partner at Airtree Ventures, and we're a VC fund focused on Australia and New Zealand. We have around 1.3 billion under management, and we're a generalist investor. We're not a specialist in fintech. We do everything from fintech to healthcare to enterprise software. I think the thing that probably carries across all of the portfolios, we try and invest very early in companies that don't have a lot, a couple of people and an idea most times, seed stage, and then have the ambition to grow much bigger. In fintech, we have invested in companies like Frankie One and Prosper and Athena, Mr. Yum and many, many others. We also have a dedicated crypto fund, so we do a lot of Web3 stuff, including things like Immutable.
Good day, everyone. Toby Norton-Smith from X15 Ventures. We're a venture arm of CommBank. We've been around for less time than everyone else, probably about 2.5 years. We launched just before COVID got very serious, maybe in the last physical meeting you could possibly hold, which was good timing. We're not actually a VC, which is probably late-breaking news, but I'm on the panel now. But very similar, actually, in objective. We call ourselves a venture scaler. We buy, we build, we invest in ventures, always with that strategic opportunity in mind of how we can help ventures tap into CommBank. So if I'm not off the panel, looking forward to the discussion.
Thanks, Toby. And my name's Anthony Boogert. I'm a partner in the private capital team at King & Wood Mallisons, and we represent fintechs and investors in private funding rounds and other corporate transactions. But I think everyone's here to hear about the investment environment. So I know James was quoted in the AFR yesterday about saying that, actually, are we not really in a funding winter, and we're actually ahead of where we are than 2020, and really, so is 2021 really an anomaly year, and is actually this year better than you think?
Yeah, I think it's always nice being the poster boy for the entire industry falling off a cliff. But I think in reality, if you do look at the numbers, they're very different year on year from last year. They're still well above long-term averages, and I think that says a lot about the state of the market relative to where it was 3-4 years ago. When Australian VC was really just getting off its the first generation, the sort of in its infancy in the dot-com crash, a global recession pretty much wiped out the entire industry, not just VC, but tech in general. And I think I've had a lot of questions recently around what a sort of prolonged pullback in the markets mean for VC in Australia today. And I'm much more optimistic today than I think any of us were back then. The reason being there's so many more companies that have broken through. There's so many more investors This is just a tiny subsample of the total number of venture capital investors and the types of venture capital investors, be it CVCs, corporate venture capital, institutional VCs like ourselves, Airtree, seed specialists, angels. There's so much more depth in the investment landscape and so many more experienced founders that are now going through their second, third, fourth time in many cases and now giving back their time and energy back into the ecosystem. There's also been many more exits. We've had lots of exits over the last couple of years alone in many of the companies that are the strongest performers in Australia. There's a lot of secondary sales that have come through, so a lot of money has gone back to the LP base. And so I think that all of that breeds resilience in the ecosystem that leaves us with a lot of confidence that with this sort of dramatic pullback, and there has been a very dramatic pullback, especially in the public markets, we'll pull back on the funding amounts coming into the market for a little while, but most likely along this returning back to a sort of trend that was happening well before 2021 happened. And I think 2021 will stand out as a real anomaly in terms of the funding amounts, especially into the growth stage deals. And it will probably also stand out as an anomaly in terms of valuations that certainly pulled back and the cost of capital has increased. But overall, it's come back, I think, to what is a nice upward trend overall at the averages.
Thanks, James. So, Ron, Warren Buffett often says, be fearful when others are greedy and greedy where others are fearful. Clearly, many people in the market are fearful right now. How are you thinking about it?
Sorry, I couldn't hear you quite clearly.
How are you thinking about the current investment environment? Are you looking to deploy capital or you're holding back?
No, absolutely. I think I would agree with James that the market is a mature state now here in Australia. I've been through these cycles 3 or 4 times back in the US, and I think the industry is mature and you're seeing a mature response. So valuations have come down. I think deal deployment in terms of capital has slowed, but I don't think it's going away, especially early stage. And I think we're in a position where as strategic investors, at least 3 out of the 4 of us, this is opportunity time for us. We have a strategic thesis. We want to invest in leading emerging growth companies that can bring value to our parent and its customers. And this is a time when valuations have come down. The need for capital hasn't decreased for these companies. So we see it as a really good opportunity to accelerate our efforts and invest and try to find those strategic relationships and partnerships.
Thanks, Ron. And Amanda, how do you think about what NAB Ventures can bring to a portfolio company relative to, say, another institutional investor?
Yeah. This is where we get to jump on James.
I figured that, actually. I was going to say, I just agree with everything that Ron said, and we'll see what James has to say. I mean, again, I think we're also looking at it the same way, right? We see a lot of opportunity at the moment. I mean, the positives of CVC is that not only do we bring capital, we're also bringing, in most instances, something ranging from a proof of concept all the way through to a commercial partnership. So you're bringing capital, but you're also bringing an ability for those companies to increase their ARR, which then usually allows them to go on and raise, at a higher valuation in their next round. And, financial services, the reason why we're all here is there's still an enormous amount of innovation to happen in the financial services sector. And there are a lot of companies out there that have, come along and are trying to help our parent companies provide the best products and services for the customers. And that can be small C consumer all the way through to our institutional customers. And so I think, as Ron said, we're out there, we're active in the market. We do try and look for that strategic relationship early. And one of the things I think we've had a fair amount of success is just making sure that we have buy-in from our executives and primarily from the business leaders that are going to be working with those customers, because it's a partnership, it is a long-term partnership, it's a marriage.
Thanks, Amanda. And Toby, you were saying earlier that X15 is not even a corporate venture capital unit, it's something else. Can you please explain that?
Yeah, very happy to justify my presence here. Look, we do make investments. When we invest, we don't do it through a closed-end fund with the GPLP structure. We're investing off CBA's balance sheet, which has obviously its own pros and cons. Look, I think maybe I'll pick up from where Amanda left off. I'd agree. Like if you look back at the track record of CVCs, and I'll lump ourselves in for now on that. You know, the objective is relatively similar, right? It's that how do you identify that point of strategic leverage, you know, that opportunity to bring the scale of a corporate, be it through, you know, procurement, partnership, debt funding, whatever it may be. How do you bring that to life? I think, you know, if you look through the portfolios, you know, globally, the conversion rate's, you know, strikingly poor on delivering on that promise. So I think we're all chasing the same promise. I think, you know, where we started a lot later and have probably tried to focus most on is how we can bring a slightly different offering, which is sort of technology and compliance services. They don't always sound like the most attractive combination to our ventures in the portfolio. And so, you know, X15, we call ourselves a venture scaler, which sort of gives away what we think we're about. But we operate on a platform of people, of technology, of operations, which we call X-Stack. You know, and the promise that holds out is sort of in two parts. You know, one is to help a venture scale. You know, but when we're talking about scale, we want scale that is repeatable, that is consistent, and that's scalable. And so, you know, we believe we need to do that through technology. So we spent a lot of time on building out the right integration points into CBA, be that to consume services from the bank, be that to, you know, access customers at relevant moments. So that's promise one. Two is, you know, really back to the parent. And I think we all have similar challenges here. It's providing the bank, you know, with the right assurance that those ventures, you know, when they plug in to the corporate asset, can sort of meet the obligations that the bank faces and needs to meet for its customers, which is sort of the, you know, the enduring challenge of how you bring great ventures and great new products into, you know, more regulated, more conservative environments. And again, as much as possible, we're trying to solve that problem, you know, through technology, through, you know, monitoring and assurance that ventures, without us getting in their way, you know, are deploying code in correct ways, that we can demonstrate, not document, that their architecture is sound, that we can ensure their workplaces are secure. That's the sort of area we focused on. So probably a slightly heavier investment in, you know, a big central team that drives that engine. You know, we do invest, but I think, like many of us here, we're happy to follow, or actually, you know, follow the expertise of other VCs to sort of identify sometimes what the right opportunity is.
Thanks, Toby. James, your right of reply after having been ganged up on by the three around you.
If you've ever wanted a bigger bear market signal, it's having 3 corporate venture capitalists and 1 institutional VC on a panel. You'll know that we've hit the bottom when it flips around that ratio. I mean, the beautiful thing about being an institutional VC is I'm accountable first and foremostly to my founders. LPs, obviously we are paid to return money to our LPs in many multiples of the money they give us, but the way we do that is by being accountable to our founders and working hard for them, and everything else sort of will play into that as long as we get that piece right. And so I think when you're out looking for capital, I think, you know, there's probably 3 things you're effectively buying. You're buying money, which is the most commoditized asset on earth. You're buying support, and you're buying alignment. And I think support comes down to the different type of how different organizations optimize the level of support. Well, I'm a generalist investor. I'm not a fintech specialist. So I am always going to be out there providing generalist support, recruiting, strategic planning, how to do fundraising, US expansion, etc. I could never dream of being able to help you in the same way that these guys can when it comes to navigating the various levels and the politics of getting into banks, financial regulation, all this sort of piece. And so as a result, many times, and we've co-invested with all of these funds and have had good experiences in each case. A lot of the times you are optimizing at different parts of your journey for that different level of support. But I think I don't want to sort of overweight the support. It's a key part of the decision, but that third piece, that alignment, is also key. And finding someone who you are aligned with in terms of the belief, someone who you trust and someone you can work with, and that can be anyone. That is much more of an individual relationship-based thing. And as I said, I've invested with all of these investors, and I know that we are all really focused around that relationship building and that trust building as the core element of all of our investments. Because if you don't have that, it's a hell of a long journey to be misaligned. And when I say aligned, I don't mean someone who's going to blow smoke up your bum for 10 years as a journey. I think you can't have someone that's just out there cheerleading, but you do need someone who is aligned and that you trust and who believes in the overall vision of where you're going and can be used as a sounding board to try and bounce ideas and sort of sometimes tell you where things sound crazy and otherwise sort of really encourage you out, because there's some hard times as a founder, as all the founders in this room will know.
Thanks, James. So let's turn now to where we're all looking to deploy capital. So I'd first like to ask, Amanda, where are you focused? Where do you see the most opportunity in the next 6 to 12 months?
You listening? Ready? We're going to. So as I said, right, so we range all the way from ag tech, prop tech, all the way over to blockchain. And I think that we're always looking for companies that can either partner with us, and it could be back-end technology, or frankly, it could be, direct to customer, small c or institutional. And at the moment, we're finding, some of the things that we're interested in are sort of the embedded finance space. I think SMEs are always struggling to find ways that they can actually spend more time on their business versus, doing accounting, doing finance, doing whatever else it is. And that's been around for a while, but I think that there's still a lot more room to grow and to find ways and to help them. Just based on the panel that we're coming after, digital identity, everything. I mean, there was a fraud panel, a cyber panel earlier today, and this is going to become, I think, more prolific as time goes on. Just the fact that we all spend most of our day on some sort of a device. So digital identity and allowing people to kind of own that and keep that safe. Data is always a big thing for us. Banks have a lot of data. Other companies have data. Like, what do we do with that, and how do we make that work for our customers? And because we've seen a lot of payments people here today, I have a little bit of a particular bent to payments, but we're always looking kind of for opportunities in payments, and that can be, again, from sort of merchant services, all the way up through to sort of the large institutional customers. There's many more, but I'll see what Ron's looking at.
Probably the same stuff.
Toby, how about you?
Yeah, I think when we look at, everyone's made the point on strategic alignment, so it's a combination of a top-down exercise of making sure you're investing and looking at places that, in our case, our LP, it cares about, but then also doing the bottom-up work to find, alignment with a founder, with a team or a venture that's sort of, happy for the model that we offer. So, I think it's actually, in many ways, business as usual for us. I'd say some of the areas that resonate for us, any of the sort of big macroeconomic challenges that really the country faces, CommBank and its customers face. So, home buying, that end-to-end journey, we've made, a bunch of investments in. Many of them, I think it's resonating. I'll pick the example of a digital conveyancing service that we actually built. We plugged that into the CommBank app at the right moment, and the sort of take-up rate inside the app increased 10 times for that service. Customer sat really high. So we're quite motivated by finding those journeys that already make sense to a customer of CommBank and then plugging them in at the right time. So, home buying, employment, many of the areas, Amanda mentioned, I think, really, really matter. The other point I'd make is, banks, obviously everyone looks at banks as enormous sort of profit pools, and opportunities to go after to sort of bring new customer service offerings. They also represent enormous cost bases. The OPEX of CommBank is, about $11 billion a year. It's, larger than the profit pools. So again, I think there's so much opportunity there. We've spoken about sort of payments and embedded finance. The evolution I'm seeing and excited about is if sort of version 1 of a lot of that functionality from, many fintechs was some version of, helping, originate and onboard a customer and then provide basic rails. I think version 2 is how services in this room are starting to provide technology and automation around, back office functions, often where the real cost and where the actual real separation in performance of banks can exist. So that just gives you a flavour of some of the stuff we're looking at.
Very interesting. So I think let's turn now to sort of areas that you're steering clear of. Ron, when we caught up beforehand, you gave your totally unbiased view on neobanks. curious to hear more about, and there's obviously been a lot of media attention in that area in the last 12 months or so.
You're asking me in this crowd to talk about neobanks. Thanks. Look, unfortunately, there was a proliferation of new businesses that we all hoped would be successful because, quite frankly, whether you're CBA, NAB, or ANZ, if the customer experience qualitatively increases, it causes all of our parents to have to up their game and provide better products and better services to the Australian consumer. So I think what we saw was a proliferation of companies globally that were attacking a problem, whether it would be FX, whether it would be supply chain financing, whether in the US, student loans. You saw companies arise that were solving a specific problem where there was massive inefficiency, and usually costs were just out of control in relation to the customer experience. And I think they've been really successful in scaling those businesses. I think what we saw here in Australia, we saw it in the UK and a little bit in the US, was I want to be a bank, which means I need a license and I have to have all the regulatory compliance issues. I need people to give me their money so I have a balance sheet so that I then in turn can lend, which is where all the profits of these organizations are derived, not from just holding an account or providing a great app. And we looked at that early because they all came in to raise capital from us early on, and it was really difficult to see how they'd be successful in a general market, let alone when there's a market correction, which we're experiencing now. So when cost of capital goes up, when there's stresses in the system where capital evaporates in terms of availability for alternative lending, we saw that as just a rough sea, and you need a balance sheet. You need to have years of being a regulated ADI in Australia to survive these markets. And I think, unfortunately, you've seen most of them either sell or close their doors or pivot to selling their technology. And personally, I think it's unfortunate. Not unexpected, but unfortunate. And I'm hoping that the next wave can take more of a point solution. I think we're seeing some of that with the work in Unloan that CBA has done. We've backed a company called 12 Finance, which is really trying to create a digital mortgage process that's fundamentally different. So I think in the market, there will be solution providers that will come back up, but they're not going to try to take the whole thing and try to really go down that ADI path, especially in Australia, which is a very overbanked market. There's a lot of banks here for a very small population. So unfortunate, but not unexpected.
Maybe if I could just add one more. I thought that was a really good summary, Ron. One more B to the equation. I think, not always a popular opinion to express in this room, but I think we've seen the importance of balance sheet. We've also seen the importance of brand, and so to draw in the example, Unloan's a digital mortgage business that we chose to build in X15 and launched in May. It leverages those integrations I discussed, so it consumes payments, account, customer APIs from CBA, and therefore inherits compliance, treasury funding from CBA. So, and the ability to say, backed by CommBank. We've found it's early days, but both balance sheet is obviously advantageous, but actually the importance of brand. Now, brand is nothing if you can't stand behind it, but if you can say, hey, this product has been, built by, assured by, we're finding that's really helping in customer consideration. And I do think that is one of the other challenges, is, how you scale a brand that really appeals to, large, middle markets of customers as well.
So James, when you're looking at fintechs, would you have a preference towards an unregulated business to try and stay away, or you don't? I mean, obviously there's a big difference between an ADI and maybe it's just payments business or another licensed business. But
I'm extremely open-minded about it because I think the minute you try and sort of box yourself in one way or another, a founder will come out of left field and surprise the hell out of you by making something work. And I think in that sense, we're almost proudly anti-thematic, and not just in fintech, across all of what we do. If you took a sort of McKinsey-style analysis of the Australian market and tried to identify where the next great startup would come from, you would probably find financial services or ag tech or mining tech, but you would have missed the Canvas of the world. You would have missed Atlassians as well. There's no way that you will be able to identify the real outliers by focusing too heavily on a specific thematic. And so as a result, we try and force ourselves to be open-minded in that. That said, we obviously want to come into these conversations with a prepared mind, and we spend a lot of time sort of digging deep into some of these thematics so that when we do see something that comes across our desk, we can try and connect the dots, not just from fintech, but from all the other businesses that we look at as well. And I think one of the failure modes that we have seen a few times in the Australian market is businesses that are trying to import models wholesale from overseas and try to apply it to the local market without making those adjustments that you might need to take into account regulatory changes or competitive changes. And the neobanks are a great example. There's been some challenges just by virtue of the fact that interchange is so heavily different here than it is in the UK and the US, and it requires much more capital. It's much more difficult to build those models. But we're already seeing some of those, and I encourage founders to think about when they are looking at these models, and if you do want to set out to build a neobank, and I think there's a really, really good opportunity in Australia to build some of these, is to leapfrog some of the models that are happening overseas. I'm seeing some phenomenal stuff that has Web3 as its core, that is building for a new set of customers that doesn't really know or care that Web3 is at the back end of it. And that unlocks an incredible amount of opportunity to build products and features that the neobanks that we had in the last 3, 4, 5 years would never be able to unlock. And so I would sort of encourage people to sort of not accept the meme that neobanks won't work in Australia, because it's bullshit. Something will surprise us, and it's all about keeping an open mind for when that does happen.
Can I just add
Sure.
one thing on that? And I think it's just about understanding the customer here in Australia. And if you look at South America, if you look at Africa, so we're a global investor. Obviously, this is Australia, so we're talking about Australian startups. But there are business models for neobanks that are in other parts of the world that really do make sense. And it allows people access to basic banking that everybody here pretty much takes for granted. And yet it's really, really difficult for them to be able to literally pay their electricity bill. And so I think, to James's point, really understanding the customer base and what is going to be of value to the customer base when you're already sitting in a country where, going to open a bank account isn't as difficult as it is in many, many other parts of the world.
Thanks, Amanda. So I think it looks like we're at time, so I might open it up now to questions from the floor.
Come on, there's got to be some questions beyond red or white wine. No? Going once? Going twice? Oh, okay. You just want me to get my step count up for the day.
Thank you. So when you're being pitched a new idea, how quickly do you make up your mind? Are you going from gut instinct? Is there something you're looking for, and any red flags?
So the question is, how quickly do we make up our mind? So many things that question depends on. No, there has absolutely been cases where I've made up my mind very quickly, and there's others that we've got to know founders over the course of 2-3 years sometimes. And so it's a real sort of piece of string type question. I think by and large it really depends on stage though. I mean, we do 96-7% of our investments, our initial investments are at seed stage, and the vast majority of them are pre-revenue and in many cases pre-product. So there's not a lot to go on when you ask for a spreadsheet with all the metrics. It doesn't exist. And so then it's really about team and dream, and that's about getting to know the founder on an individual basis to try and identify what special insights they have on the market and actually what's driving them. What are the motivations that they are that are pushing them along to build this particular product? Because as we know, this is a long journey and there's loads of ups and downs, and those ups are high, but those downs are low. And so knowing and understanding what makes that founder have the motivation to push through those is incredibly important for us. And we spend almost all of the initial meetings that we have with those founders trying to understand those ambitions and those motivations.
I'll take a crack for the strategic side. We have a more challenging job because before we get to that analysis, we have to decide if what they're trying to do is within our strategic focus area and is going to be a potential benefit to our respective organizations who's deploying the capital. We're doing that for them. So we have to make that strategic evaluation first. Now, we can do that relatively quickly. It's thesis-based. We kind of know which areas we're investing in, which look a lot like the ones that were already discussed. The second part, I would agree with James. It's if you have a team coming in that's been there and done it before, and I've fortunately in my career, I've been on James's side longer than the corporate side. And when you have an entrepreneurial team coming in saying we're doing our third, and you know us, it becomes a very easy equation because you can get to a yes much faster. If you don't have that experience in the team and that trust in the team, you have to develop it. And that takes the time that James is describing. You have to spend as much time as you can to really understand their capability, because in the end, we're not investing in the TAM, we're not investing in the tech, we're investing in the people. And I know that's a cliche, but it's actually true. In the end, I don't believe the TAM, and in the end, I assume the technology is going to work. And if not, you're going to figure out how. But it's all about that team and our belief that they have the right vision, and if not, they're going to know how to go after the vision that they have to achieve to essentially get the strategic value we're looking for and return our capital.
On the team piece, I always tell our team that sometimes the best time to meet founders is when they're not raising, and really get to know them and spend a lot of time with them when it's not under the pressure of people actually really, really needing to raise funds, or they've already got a lead term sheet from someone, and there's a time limit now on when you have to do your work. And to Ron's point, we can take a little bit more time sometimes with the work that we need to do, but I think it's always a good time to meet with VCs, and it's always a good time for us to meet with founders and just get to know people and get to understand what they're trying to do, because it really is about the people.
With no pitch deck.
Well, no, it's more fun if there's no pitch deck, right? Yeah.
Now they're all keen. I'm going to ask a quick one as I go up there. How do you respond to the question that was, or the proposition that was put to me that 2021 was the year of VC FOMO? And have you guys ramped up your due diligence consequently in 2022?
I think last year was the year of FOMO for VC. And have you now ramped up your due diligence?
I think, at least I can take a shot at that. I think we do about 1 or 2 deals a month, and that hasn't changed over the course of the last 4 or 5 years, really. There were definitely situations where you had to do that work a hell of a lot faster in the last year. In fact, I think the overwhelming feeling from most VCs I speak to, is particularly the growth funds in the US, is one of almost relief. A lot of their portfolios are completely underwater, so they don't want to think about that. But they're almost relieved in a sense that they can actually get to know founders a bit better and take more time to make these decisions. But the good VCs, certainly the ones who had super funds or pension funds or endowments in the States to answer for, were doing the work in a much more compressed time frame, and it was exhausting, frankly. There were times when we would see companies on a Monday there was a few times last time where we were having to sort of wrap up the same amount of due diligence, the same customer calls, the same modeling work that we'd do for a growth stage follow-on investment from our own companies. So we even had a bit of forewarning that it was happening in the course of about 3 days. And you don't sleep a lot in those 3 days, but by and large, you get much of those diligence done. Nowadays, we have the opportunity to get to know and build the relationships before you have to click into that DD mode. And when you're in that DD mode, you've usually got a few more weeks, which frankly is a massive coup for work-life balance when it comes to being a VC. I wasn't complaining, I love my job, but that was pretty intense.
So, James, we've heard about you and Airtree's Web 3.0 fund, but given we've got 3 of the big 4 banks, CVCs on the stage, it'd be interesting to hear from them about what the big 4 banks and the venture arms think about crypto, digital assets, Web 3.
You want to start, Ron?
Sure. For those of you that heard the panel earlier on stablecoin, you've heard some of the things that ANZ's doing, and Nigel Dobson was on the panel. So we're actually looking to support the institutional side of ANZ in their stablecoin ambitions, in using stablecoin for carbon trading markets and other use cases for customers. So we're very much focused on that sector. We are also very supportive and are actively paying attention to what's going on in the Web3 space. I think if you look at crypto as a concept, or Bitcoin or other cryptocurrency as a repository of wealth, we are staying very far away from that. There's just not an ambition within ANZ to pursue things around that outside of the use cases that they're being built around the stablecoin environment.
I can't say anything that's too much different. But so again, NAB's focused more on the institutional side than on the personal banking side as it relates to this. NAB Ventures made an investment earlier this year in a US company called Amber Data, which is, I think the easiest way to describe it's probably a little bit like the Bloomberg for digital assets and kind of that entire space. It allows us to really see exactly what is going on, even if we're not, participating in it, but definitely more focused on institutional. I think there's a difference between, the underlying technology and blockchain and what that can do in areas like carbon credits or in ag or in, other subject matters versus, just looking at, the crypto assets, digital assets, which is not, what we as a venture firm, are looking at.
Yeah, I mean, sort of ditto those points, not too much. We're pretty focused on those points of leverage that we spoke about. And so to the points on, crypto, for X15 at least, we see, more opportunity of sort of models that are probably ripe for bringing to customers that we'll focus on. So it's a very similar answer to my corporate peers.
Great panel, thank you. My question is about diversity in funding. We've seen a lot of strident criticism of funding of female-led projects, female-managed, projects. And, there's other areas, right? So whether it's other minorities that aren't seeing that funding. I was curious as to whether or not any of you've got any specific initiatives beyond awareness training, but just specific initiatives around how you fund, who you fund to start to shift that needle away from, we're going to call it straight male white funding.
Yeah, I'm happy to throw a few thoughts there. It's something we're incredibly conscious of, the challenge, and wouldn't for a second profess to say that we've got the answer. The law of percentages will sort of misrepresented. 40% of our founders are female. That means 4 of 10. So I sort of don't want to overestimate that. I mean, for us, one of the points harking right back to my sort of confession at the beginning that we're not a classic VC model and not equity incentivized, I think there's something interesting for us in the slightly different risk-return profile that we offer out to founders and ventures. You think about that trade-off of, a little bit more assurance from the venture vehicle, a little bit more support to plug in. So it does change the risk-return profile a bit. We've found that has helped attract, not just at the founder level, but within teams. We track pretty well on sort of, a few metrics of diversity that we measure. Beyond that, I'm sure everyone's got some views on this. Another thing, we love partnering with, organisations like, Startmates Women's Fellowship. We find tremendous talent who are sort of looking for that opportunity, often who are in corporate, don't have the privilege or the presumption that they can launch straight into the all-in equity model and the sort of X15 model, be it inside the core team or inside a venture, is a sort of nice stepping stone. So again, don't have all the answers. I think there's a long way to go, but that's one thing we've thought about is the incentive balance.
And Amanda, do you have something to add on what NAB's doing there?
No, I'm just so happy that somebody asked the question because I was trying to work out how I might be able to weave that into the conversation. But we do definitely focus on that. And I think most of us have probably read the numbers, that are in the diversity bucket and can see the low percentages of capital that actually goes to diverse founders. And that's just not female founders, that's diverse founders. I'm proud to say that we've made a number of investments in the last 12 months with at least, one female founder. That is something that we look at. I think we still have strides to go. Half of our team, we're a 50-50 team. So we hope that will help us improve. But we have work to do, but it is something that we're very conscious of.
Can I just add a few? Because I think one of the numbers are shit. that's really, really poor. And I think the numbers, everyone tries to get a free pass by sort of identifying female members of founding teams and counting that as a block of, yes, we've ticked the bucket. If you actually look at the numbers, just purely take all the founding teams and split it up on a gender basis, the numbers are worse than the numbers you often read. So the numbers are terrible. And it is something that absolutely needs to change. And I think the way we think about trying to change it, and we are part of the way through a long journey of this, both at Airtree and I think as an ecosystem. It has to change at the top of the funnel and the bottom of the funnel. I think the way we think about it, at the bottom of the funnel, you need to have diverse voices around the investment table, which means you need to have investment decision makers which are diverse. You need to have partnerships which are 50-50 or close to it. And that's one of the things we've been very focused on, is making sure that we've got investment decision makers, an equal split amongst the partnership that are making investment decisions, because that's where it starts. But even then, and we've had that for now 3 years, even then, that only slowly changes things, because then you've got to focus at the top of the funnel. And the top of the funnel is where you can encourage more and more female founders to think about, before they're even founders, to think about jumping into the space. And that's where we've been really trying hard. We've got a program that we've launched this year called Pioneers, which is finding people who haven't even thought about joining companies for whatever reason, and just encouraging them to network amongst their peers who have, and amongst each other, and having the support network to do that. And they may never do that, but some might. And that sort of creates at the top of the funnel. And then there's the middle bit of the funnel, which is the earliest seed stage investors. And one of the big focuses we've had over the last couple of years is trying to improve the diversity amongst angel investors. Because if you don't have diversity amongst angel investors, then there's a big chunk of this investment stack that doesn't have the diverse voices you need. And if you think the VCs are underrepresented when it comes to women, you should look at the Australian angel market. It looks like an old American university football team photograph. They are all old white dudes. And the more that we can get to encourage women into angel investing, the better we have. And there's a big chunk of what we're doing with our Explorer program is to make sure that that is an opportunity that is open to more and more people.
Thanks, James. Ron, any final thoughts before we wrap up?
No, I think all of those are really good points. We're committed to trying to increase the diversity and help coach and train up the next generation of female investors. But unfortunately, we're not a seed stage investor. So what we're trying to do is support organizations and try to support the organizations that are trying to train and coach up and create the entrepreneurs that then can come through that pipeline that James was describing and then be available for us to invest in. So I think we're trying to approach it as being part of the ecosystem, though we can't directly do what an institutional fund can do and go early stage and try to create those vehicles. But yes, we are absolutely, and I agree, I think it's great someone brought it up, and thank you. And it's a long-term multi-solution. There's no silver bullet here.
Okay, well, look, I've completely failed everyone by going over time, but so let's please put our hands together for the fantastic panelists and Intersekt.
And thank you to Anthony. Thanks, guys. Well done. End of day one. Go out, have a great time. Leave some brain cells for 9 a.m. tomorrow morning when we kick off with crypto and Web3 here in this room. Thank you for joining us at Intersekt. I'm Simon Thompson. Have a great evening. Bye.